This episode is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings. Thank you so much for attending Macro to Micro Power Hour. Apologize for a little technical difficulty getting started, but we are here, and we had a really boring FOMC release with Powell presser as far as markets were concerned. They were much more interested in the miss, if you will, on CPI. Long story short, we didn't really have any selling. We literally closed where we gapped up. So we've got lots to kind of unpack with the CPI and the new SEP or dot plot path, but ultimately market kind of already voted, and they're pretty darn happy with the lay of the land. Craig, just give us an update on what we saw this morning, CPI, and then with the new one cut from 3 scheduled later this year or early next. Take it away.
Yeah, thanks. A wild day because it's pretty rare that you get the CPI on the same day as the Fed. I think it's the first time in the last 4 years or so that we got that. So look, I think after the strong payroll print from a couple of weeks ago and the economic data that had been coming in, it was my view that, the Fed was going to need to be a little more hawkish on this at this meeting and in this dot plot, removing cuts for 2024 and 2025 and likely raising the neutral rate because financial conditions had eased so much and it wasn't clear that inflation had really been making any progress to get back towards target. And so that was kind of my bias going into this morning. Into the CPI print, which I really, no edge on that. I mean, for the most part, 15 street economists were kind of targeting in on 0.28% month on month. 50 or so Bloomberg survey targets were basically around the same thing. So, everyone was really kind of tied in on this number. And look, when 60 economists are largely agreeing. So I didn't really think there was much edge. And, look, I thought there was a chance we could round up to 0.3, maybe a little bit higher, or we could round down to, 0.2 and it would be a little bit more dovish, but it really probably wouldn't change what I thought would be a hawkish Fed meeting. But then the CPI comes out and it is a kind of I guess that's a left tail or right tail. I don't know. It's an exogenous number. It really came very far away from where anybody was thinking. So, 0.16% month on month, which rounds to 0.2, but it was a weak 0.2. And super core, which is core services X housing, was negative, which is what you're showing here right now, which is the first time we've seen that in over 3 years. So, clearly the month of May versus the month of April, because that's what month on month is showing, some more signs of, disinflation or even maybe some deflation, which is the first good data point on inflation that we've really had this year. I mean, recall the first quarter of inflation prints really went the wrong way for the Fed. And even the April print, which came out last month, was, better than expected, but still not great. So this was the first of 5 this year. And folks went with that and said, look, this is great for risk because it means the Fed is going to be more dovish at the dot plot, and it's likely that they're only going to give us 2 cuts for 2024. And worst fears about being hawkish are off the table. Powell's always dovish, and we're off to the races. And that's very quickly how we traded right from 8:30 through basically through 2 o'clock, which was small caps leading because they've been the relative underperformer, but still, and NASDAQ was fine and SPYs were fine and bonds ripped and gold had a move and ripped and crypto was ripping and it really seemed like it was this risk on environment, exacerbated as well by significant vol selling. Right, we came into the day with a very elevated 1-day VIX structure for today as expected. And so when we removed kind of the most hawkish outcomes, it just the market just kind of sold off vol, and we levitate on that. Dollar was weak as well. Oil rallied. And that was the construct through the day. And, to me at that, up until 1:59 p.m., my view was, coming into today, I thought they were going to go to one cut for this year. And even I didn't think they were going to do it after this morning's print. So at 2 o'clock, what they came out with was basically a hawkish surprise versus, those recent expectations, because the Fed came in and said that now they only really expect one cut this year. I mean, right, you have it there. 11 members are at 0 or 1 cut. 8 members are still at 2. And then when asked on the press conference, if today's data had been incorporated into the dot plots of the members, Powell reiterated that as is the case when this has happened in the past, members have the ability to update their forecasts based on this new information. And this is the dot plot. The dot plot is reflective of today's data. So to me, that suggests a Fed that is basically saying we are, yes, we're happy that we finally got a good inflation print, but no, we are not ready to provide accommodation to this market and to this economy as is being priced in by investors, because we just want to be sure. And the economy is doing great and better than expected. Took the GDP forecasts were kept flat, but they raised the PCE forecast for 2024. So they just want to be sure. And Powell, when asked, he said, we need to be reminded that the base effects of the easy comps from the second half of last year start to roll out as we push through the year. It just makes it mathematically harder to actually bring PCE down, because the readings from last year were so benign. And so that's why the Fed is at 2.8% for 2024. And that's a lot of why members now are really only looking for one cut this year. And so to me, that achieved a lot of what I was thinking from the hawkish perspective. Now, I thought there was a very mild, minor chance that they would actually also remove an additional cut from 2025.
But they didn't.
Because, I thought this was the way that they could really try to push back against the market pricing and against financial conditions easing, and really show that, they're going to be at this for a while. They're not going to be reacting quickly. They decided not to do that. So they've kept in the 4 cuts for 2025. So they just kind of really, I guess you could say, they really just kind of removed 1 cut from the 2 years. So yes, but still, in light of what we got this morning, I think that's hawkish. Now, look, the question or the positioning that I'm thinking right now is what I believe you have is an economy that is increasingly showing signs of stalling out and of strain, and more parts of the economy are being negatively impacted by higher yields. And the longer that we exist at these levels, every day, the more companies that have to refi are going to be refining at higher levels. Consumers are going to be strained. Housing's going to struggle, autos, etc. So we're finally getting these long and variable lags of monetary policy offsetting the positive benefits from the rate hikes, which came to rich people and to corporations with higher interest expense. So we're slowing the economy, but because inflation is not rapidly moving back down to target, the Fed is not going to react quickly to that slowdown in growth. And so either investors who are getting constructive on earnings growth momentum in a slowing economy, I think that is not a great reason. That's not going to happen. That's not a great reason to buy equities. And if you're buying equities because of multiple expansion, because you think that rate cuts are imminent, well, that also doesn't seem like it's going to happen quickly. So look, I don't really see such a reason to get super excited about, and again, I've said this on every week, but on small caps and on cyclicals and on, non-Mag 7 or now Mag 2, Nvidia and Apple. But you don't need to come after NASDAQ, but there are parts of the economy, there are parts of equities which I don't like. And I think that that construct kind of still kind of holds water. Now, look, we're in the middle of this is the second week of the quarter. We have big options expiry next week, and we know it's difficult to crack equities as these VADA and charm flows and buybacks into next week are there.
And specifically, VIX expiration is Tuesday, not Wednesday, so we're pulling forward a little bit.
Yeah. So yes, I know it's difficult, but again, if we're not going to get a imminent rate cutting cycle, and look, 11 members of the Fed are basically telling you that they are not going to be cutting until December. At
earliest.
So
if
I don't really know, why that's gonna lead to an earnings growth reacceleration story. So that's kind of how I saw it. Now, look, once Powell stopped speaking, and truthfully, even until 2:30, I was like, oh, Powell's gonna be dovish. I mean, the guy's always dovish. He's literally always dovish. So he wasn't dovish. Like he normally is. Now, I wouldn't say he was overtly hawkish, but for him to not kind of say that he thought that rate cuts were look, he was more hawkish than he normally is. Let's put it that way. So
yeah, so I have a quote from him that actually was pretty darn hawkish relative to where we are. But I wanted to let you finish, and then I wanted to show that because actually that was
So look, so as once he finally stopped speaking. That was basically the high, right? Or we started to sell off because then you have to think about positioning for the reality of what we have, and the reality is again stalling growth, still largely sticky inflation, and a Fed that's going to be slow. So that's do what you want with that market. And so what we saw yields start to move higher after an initial crush. We saw the dollar start to move back higher. After that crush, gold sold off, Bitcoin sold off, WM sold off, and Nvidia did its thing, and Apple did its thing, and there are 4 million Apple calls that traded today. So I mean, look, it's still wild, it's still crazy, but I don't really, I don't really have much of a change in the way I'm thinking about, my setups right now.
Archana's popping in and saying Avgo's rallying too, which not a surprise. It's all part of the NVIDIA, semiconductor AI tech ecosystem. And they're also saying they're going to do a 10-for-1 split. So yeah, the tech momentum is strong. Let me just show you a few things you were talking about, and it got my yeah, there we go. Okay, so Zoltan Pozar. 2% inflation and going back to the old world, I don't think it stands a snowball's chance in hell. Zoltan, tell us what you really feel. And we are in agreement, right? Like this is entrenched inflation. It is something that on Main Street, we've got compounding inflation, since COVID, even if the rate of change is slowing. And that's exactly what we saw today in some key numbers. Especially since gasoline has kind of, it has definitely fallen through April. So the May look was very nice as it relates to this kind of weakening inflation backdrop. But big picture, I did like the one quote that he put, and I actually retweeted it, which was Powell says, if economy remains solid, which we do have some economic growth, even if it's not reaccelerating. We do have some, the richer, of course, making money, no question about it. And if inflation persists, there's no reason for it to really fall strongly. They will keep rates where they are for as long as needed. So that is nuanced, hawkish talk. They're not going to be doing a hike. And most likely not even a cut, just like Waller keeps saying, and, not until end of year or beginning of next year. So they don't have consensus, right? And no consensus, no cuts. That's been your mantra for months and months. So I have a little bit nuanced, feel on this as far as trying to get some levels to tactically trade this Powell presser. It was completely uneventful. We literally, gapped up on CPI and chopped around there, and there was just really nothing else going on. Maybe on a micro scalp time frame, but not as it relates to swing time frame or even trends. Trends are fine. Swings are obviously rejoicing long because NASDAQ is at all-time highs. Amazon looks like it wants to go there. Microsoft already has, Google already has, Apple already has, and NVIDIA already have. And so the moat of the big, the Mag 4 is absolutely where money has rotated, and defensive didn't fall apart. XLP, XLU, XLV, they just they're grinding sideways while money is still rotating into tech. So at some point, it'll pause and start to reverse, and money technically should go broader into the market, or we're going to have an equity correction, because that's my baseline bet. In lieu of sector rotation, there will be volatility. So for me right now, I'm still in this camp of, it's higher for longer until recession. And right now, we don't have any signs of recession because unemployment has not ticked up strongly. I think once we do get above 4.2% unemployment, we will get some drama in equities. They'll, start to pull forward recession risk, but right now 4% is just not enough. I still think higher yields are clearly making lots of those with inflationary assets and those with money. They're making money on their money. There's no question. It's bifurcated. Those who don't have assets and or cash, then they're suffering terribly. There's no question about it. But the wage inflation has helped to delay recession, and that's still a thing. We just saw that last month when we were here 2 weeks ago, right? The year over year is 4.1%. So we're going to see higher yields slow down the economy, but it shouldn't be fast, right? It should be a slow train unless we get some reason to disrupt these bulls out of their complacency, or a macro trigger to disrupt the very bullish option flow. So you've mentioned one thing, which is options expiration for sure. And we don't have to worry about rate hikes. We really are not going to have rate cuts. But what interested me was the fact that rate cuts, even though they were pulled out of the market 2 this year, right? Like you just said, you were surprised they didn't take 1 out of 2025, but they definitely took 2 out this year. The market just said, hey, economy must be really, chugging along and doing fine. We don't have to do anything. Let's just maintain this Goldilocks, status quo of economy is fine, wage inflation is fine, people are still making money, housing hasn't fallen apart, used cars have fallen 58% from their COVID peak. There's still reason to coast. There's still reason to coast for Fed, Treasury, and for market, I think, bulls, until the 10-year falls below 4.2%. I think that would absolutely make the market go, wait a minute. I thought the market was really strong. Inflation and yields were actually good for us. Now you're breaking some thresholds here. Maybe we're in trouble. And I also think until 4.2% triggers on the unemployment rate. So that's my kind of overarching view of how the rate cuts right now getting priced out isn't necessarily bearish. I still think the market is fine, and they're manifesting, their bullishness by buying tech. So make hay while the sun shines.
Yeah, look, I mean, I think anybody who was looking for, this broadening out, this rotation into, out of tech and into small cap, or out of growth and into value, to come into the year. I mean, it's not happening, right? Qs are breaking out to, versus everything, versus IWMs, to multi-decade highs. I mean, and now with Apple kind of having its, 10% or so move, whatever it's had in the last 2 days. I mean, just broadening out, it's sucking in capital from everybody else, the other way.
Yes.
So look, I think that's gonna, continue until we have a beta move, until it ends, basically. I don't see an environment where capital flows out of big tech and back into these other, more cyclical sectors. At the point in time when the capital stops going into big tech, it's going to start coming out of equities. And the reason that it would come out of equities is because, you believed that rates volatility was going to pick back up. And so the question is, did we learn anything today that would suggest that rates volatility is going to go back up in the Fed or in the CPI, or do we get rates volatility picking up from international sources, whether it be Bank of Japan, which is later this week, which is talked about doing QT, or in Europe, where we obviously have political strain going on as populist movements are winning in the polls. We also have populist movements in emerging markets which are winning in the polls, right? And so we're seeing things like the peso and the rupee, and now the real, right, are moving in directions that are kind of leading to fixed income sell-off. So I think it's more likely that whatever stops this is going to come from outside of the U.S. And we'll just have to kind of wait and monitor it. But look, I mean, I don't know how much longer how many more days are we going to get 4 and 5 million Apple calls traded. I guess we could keep going for a while. I do think, expiry next week is obviously a potential turning point. The other thing I'd say is, over the course of this Friday and into Monday, there's a massive liquidity drain that comes from this U.S. Treasury auction settlements and corporate tax payment for June. So that's going to raise the TGA by about $250 billion over 2 days. So if you're looking for some short-term liquidity drain, well, we're about to get it Friday and in a big way on Monday. And then liquidity will be kind of on the back burner and being largely coming out through the end of the quarter, because the RRP typically builds into the end of the quarter for window dressing. So some of that liquidity flow that's positive from expiry week starts to go away next week and into the end of the quarter. And when we also get share buybacks start to blackout period starts towards the end of next week. So the liquidity dynamics, will start to kind of favor potential for stalling and a potential for a rollover and maybe some slowdown of this train. But look, right now, I guess it's party like it's 1999 still.
Well, let me
in NASDAQ.
Okay, yeah, I was going to say in NASDAQ. So a few things, just my color of macro risk event risks that are not really tradable yet, but they're on the radar. So first and foremost, we do have an election cycle. If Biden doesn't make it to the ballot, we will have disruption, and the market doesn't like uncertainty. But they definitely like to know what policies to expect, and we know what to expect with Biden and Trump. So there is, that, and I know everyone discounts it, but RFK is still a potential or a replacement to Biden. So we got that. Overseas, no question. I mean, FX currency risk, or I should say volatility, typically seeps into equity volatility, and we really haven't had enough of that so far with the peso yen. That very, very crowded trade and that unwind. Luckily, Bank of Japan is talking about a hawkish kind of backdrop, but they're not really doing anything, or they're talking dovish if it gets too hawkish. So they're really, really threading the needle, and so far it's been very beneficial for them, for their exporters and such, and their tourism. So they're not suffering right now. So we don't really have distress by our number one partner. But yes, this MAGA wave that's happening in Europe and elsewhere is definitely threatening some yield volatility, and the yield spreads blew out German and French. And so there was definitely some gyrations over here where even our MOVE index went higher, which was, we were talking about this last week, and I think it was kind of in relationship to some of this FX and foreign bond volatility. But ultimately here stateside, we haven't even seen 2-year drop, below a certain threshold or get above a certain threshold. We're just range bound, and markets love that stuff. So if we get a true rotation into value, it's going to be because something upsets NVIDIA, or they just say, okay, we're taking profits off the table. We had infrastructure spending, and that's been actually very beneficial for certain stocks, but they really haven't even put shovel in the ground yet. There's still lots of money flowing. There's still tons of liquidity. If they actually do start a refinancing wave this summer, because the MOVE index helps at 30-year fall, right? And then that kind of starts the movement of housing again, which is my baseline bet. Then that refinancing wave is going to put even more liquidity into the system. Okay, so that's all like stuff on the periphery that hasn't really happened. But one thing that I want to kind of highlight as a risk that is a growing concern is something that Jeffrey put together in his channel. And he's our economics advisor, and he really focuses on FDIC and the banking health. And I do mean the minutia of the banking health. He has this on his radar. This is something that happens very slowly. And we're not talking about, oh, CRE is a big risk. They've had time to heal, right? And the Fed and Treasury have come in and backstopped that whole banking crisis of March of 2023. So unrealized Treasury losses are, somehow miraculously made to, at par. But the point is, despite these promises and or mechanisms to make sure the Treasury liquidity market keeps flowing, there is some degradation of the banking backstory here that it bears watching. That's the expression I want to use. So FDIC highlights that he posted for clients a little while ago is that loans are shrinking in nominal terms. You've got 1% year over year this inflation, but charge-offs in credit cards are ramping up to 4.7%. And typically you get, and that's just 55 basis points in a quarter, above 5% historically starts to trigger some recession warnings. We know about commercial real estate going south. Bankruptcies have absolutely started to pick up. So none of this is tradable right now, but I'm just saying NIMs, the net interest margins that banks are making, is actually rolling over. You've got nothing catastrophic, but no question, he's basically eyeing the fact that the banking sector would really benefit right now from some lower rates, and maybe that's what the Fed delivers if they start to get into a crunch. So we are in crowd out because of fiscal dominance and because of this deficit spending that just doesn't have any control. But big picture, he does put this into an area of, we have increasing business bankruptcies and negative growth in loans. It's something to be, aware of. So nothing yet. Banks are still hanging in there, but it is definitely an area that I think bears watching. Any other, macro event risks coming up? Because now we're kind of through thank God, the highlights of the week with CPI and FOMC. We've got, as you just mentioned, options expiration next Friday. We've got VIX expiration on Tuesday. Wednesday, the 19th, is a market holiday. So keep that in mind. We got a 4-day week for those option traders out there. Michigan, you love that one on Friday.
Yeah.
Jobless claims every Thursday. What else is really coming up that we have to kind of say, okay, until NVIDIA breaks or until tech starts to get some solid profit taking, market still doesn't have the intensity of the breadth breakdown that I need to see to be able to call an equity correction. And I had this price target from January, right? So this is the irony. Like this 5340 SPX was my call for the year, and 444 and then 472 overshoot for the Qs was my call for the year. So clearly we hit that yesterday with that Apple ramp and the gap up today. Are we done? I don't know. That's just a price target to say, if we're going to stay in this bullish trend, and we have, those are the price targets. So now I'm looking for digestion here just because technically we hit. But what macro triggers would actually cause us to start to revert lower?
I mean, look, first of all, we do have the PPI tomorrow. So it's important because then folks can kind of really gear in on what the end of June report for PCE will be for the month of May. So, obviously after today, the expectation would be that PPI comes in very light, and that the, PCE at the end of the next month, I'm seeing estimates as low as, 0.15 or lower and on core, which is, will be a very, good outcome for what the Fed is looking for. To the extent that PPI doesn't deliver that to tomorrow, that will, I'll push those numbers back up again. So look, the Fed is looking for, increased confidence that inflation is looking for back, to return back down to target, or an unexpected deterioration in the labor market to, start its cutting cycle. And an unexpected deterioration in the labor market, Powell was asked several times about it, and he wouldn't give anything like too specific, but it would be something that is, materially worse than forecast. And so that's not going to happen on weekly claims numbers, and probably isn't going to happen even on, one week payroll print. But last month, for May, which came out 2 weeks ago, we had an enormous payroll print. So, much stronger than expected. So I think we are very far away from unexpected weakness in the labor market in the Fed's eyes. So to the extent that the rest of the data that comes out, we got retail sales next week. You mentioned the UMISH, but IP numbers, whatever, all the regional
Auctions.
PMIs, regional PMIs. If that stuff continues to show some weakness and the Fed is not going to react to it, I think that is a problem for equities. Because again, you don't have the benefit of multiple expansion from lower rates, and you won't have the benefit of earnings growth acceleration as the economy slows. So neither of those things work for equities, certainly for small caps. And so that's that'll be the data. And as far as the flows and the timing are concerned, like I mentioned, we have this liquidity drain. Really it's materially on Monday. Then we get VIX expiry on Tuesday, markets closed on Wednesday, and options expiry on Friday. But then after that, we have your kind of end of, last week of the quarter, typically as liquidity drain, as the RRP build, share buybacks start to cycle out. And that could be a period where the window of weakness is open. If you combine that with some of the early polling on European political outcomes, which are coming, or the BOJ being hawkish this week on Friday, right? You could get 1 + 1 + 1 = 10 type of behavior that folks are saying, I made a lot of money being long stocks in the first half of the year. Like maybe I should sell some into the end of the quarter. It's possible. But again, I think in order to really break the psyche, we're going to need to see rates volatility pick up or FX volatility start to pick up. We've seen a little bit of it. I think it needs to continue. And it would have to come from, I think, overseas dynamics. What China has not been doing particularly well. China, is still mired in deflation. The CPI last night was pretty poor. Government,
Which is why dollars are still flowing here, relatively
Yeah,
speaking.
look,
Foreign dollars are still coming into the U.S. markets.
Absolutely. So I think there's folks who are trying to chase China. I think that's not a great idea. I don't think chasing EM is a good idea. I don't think going into Europe is a good idea. We're getting to the last man standing type stuff. It's U.S. cash rich, big cap tech that is in the AI chain. That is the best story in the global economy, bar none. And more capital probably will continue to flow into it, certainly on a relative basis. And on an absolute basis, can it keep making everything go higher if we're getting these other types of liquidity drains? The other thing is, CTAs are full, vol control funds are full, right? Yes. Like we're pretty full. So I'm not saying that we can't keep grinding higher, but
no, but this is definitely where complacency of the bulls definitely is their weakness, right? I'm agnostic, like bull bear. What's the story? I want to see both sides. And right now, like you just said, they are satiated. They are fully long and fully complacent, and puts are so cheap. So we have to see, obviously, something to trigger them out of that. This is usually when it happens, right? When they start saying there's only one way to go. But I definitely am curious on the foreign asset, the foreign money into U.S. asset flow slowing as some of this FX volatility triggers. And I'm not a geopolitical, worrier, but there's definitely a lot of that going on around us in Europe, South Seas. So there's always that kind of backdrop that hasn't really affected the money flow yet, but that is one thing that would put a hard stop in the money flow. So always looking, but I haven't seen anything yet that really is strongly triggering time for volatility. Maybe we'll get some profit taking after options expiration. That's typically when it happens. Archnut calls out the JP Morgan caller, which is very large. You sell calls way high with the and then you buy a put spread, and this is collaring obviously very large positions. It's assumed, and it's a quarterly roll, and we're going to get into that end of quarter roll. Oftentimes, it really doesn't matter, really, to the mechanism. Sometimes it does, but it's kind of interesting that the last few quarters, so Q4 of 2023, Q1 of 2022, I think even before that. Anyway, point is that the calls, they had sold the calls, and the strike was taken out. Right. So this time they went far out of the money, and that is 55.65. So we're getting closer to that print, and especially Avgo after hours at near 1650 is going to help. But we're talking SPX closed at 54.21, and that top side collar for June 30th is 55.65. Not that far. So maybe we can, get into that 5,000 area, up into that 55 kind of area. But that's typically where they stop it.
Yeah, I mean, it's wild what's going on now and what's going on with Apple. I mean, I don't know. It feels like, what you would expect, as we're kind of getting towards like this capitulation. It's like everyone's getting stopped in.
Yes.
If everyone's underweight, benchmark Apple, and now Apple's ripping on people who have used it as a funding source against NVIDIA or whatever. Apple has a 10% move in 2 days. I imagine, some folks got blown up on being short Apple. But
there was a rumor that there was a fund that blew out because they were long NVIDIA, short Apple, and that kind of thing. I don't know.
But it's crazy. I mean, so 4.1 million Apple calls traded today. I mean, 20-day average is about 700,000. So, I mean, they are, and obviously this is not retail, right? They are big money is trying to jam, these big cap stocks to ungodly amounts, and, maybe try to run some dealers over who have to hedge. And so it's a circus, really. It really is a bit of a circus.
I have to show you something though that just occurred to me. Remember how we talked a while back and we were talking about, let me move this and then answer Marty's questions. Yeah, by the way, if you have any questions, hit us up, Q&A or chat. I'll see it and bring it forward. But let's just do this. Let's share this. Remember when we were talking about this NASDAQ run with this concentration risk? If we are in fact 1995 or 1999, we talked about this, end of last year. I remember I was kind of posting this in mid-November going, oh my God, November 16th, this thing is just a massive, this is just, it could be 1999. Well, we are up from the lows of January 2023 in NASDAQ 100, 78%. And the bubble of 1999, 2000 was 100% before the March 2000 collapse. So we haven't even gotten into bubble territory as a, kind of a technical definition. Anyway, little factoid.
Yeah.
Okay.
It's hard. It's going to be, tough to see how they break this U.S. big cap tech story and the call buying. It's really a question of do fundamental economic actors in other parts of the economy, do they start to react to the pricing signals that they're getting, and that ultimately would lead to some more P&L pain or risk off or deleveraging that would cause people to have to take down the book sizes and prevent them from doing the U.S. buying. And so we have to look for areas where the economic fault lines are, and places where people are crowded in positions, or places where elections are happening, or where, GameStop's a really perfect example of this, right? Because GameStop reacted to the nonsense of its price appreciation, right? It's an economic actor, it's a company, and the company was like, wait a minute, like our stock's up, 300% in a very short period of time on literally no fundamental economic news. If we go sell equity here, we're basically just taking money from investors and putting it in our pockets in order to survive for a long period of time, right? So now GameStop's got $2+ billion of cash sitting on the balance sheet. It's great, great for GameStop, right? They were able to
Well, it's a grift.
bet. What's it? Well, but I don't. It is a grift.
That was not by default. That was by
but they
design.
got. But I'm saying they reacted to pricing signals, right? And so I think similarly,
They
what's
created
happening.
the pricing signals, in my humble opinion. But okay.
But the company did what it should do, right? Companies react to price. Like from my view, instead of buying stock here, Apple and Nvidia should be selling stock, right? Like they shouldn't be buying their stock up here at 50 times earnings, but they both are. I mean, Nvidia is 50 times earnings, Apple isn't, but
it's cheaper than going to market and raising more debt.
Right. So eventually companies will hit the bids on and sell equity when the prices get stupid. Similarly, in Mexico, right, we had an election outcome. Fundamental players came in and said, "Oh shit, I have too much, peso. I'm too exposed to Mexico. This government's going to do some crazy things. I need to get out." And that leads to some unwind into other places. It's a very crowded trade. Maybe that'll happen in Japan starting this week when Japan announces QT, right? And that will force yields higher in Japan. So maybe it'll happen in French oat markets, right? As people start to price in Macron being thrown out and far right party kind of coming into power sooner rather than later. People say, wait a minute, do I want to own French government bonds in this environment? No. Do I want to really own the euro if there's a populist movement that's gaining momentum this summer? No. So those will be the places that real economic actors will react to the pricing signals. And in the US is a special market right now where zero data expiry plus the more hawkish Fed but fiscally imprudent or fiscally deficits from the government create this kind of imperial circle where dollars and money is flowing into the US. So it's kind of like you need to be looking elsewhere for where the signs of strain or where the signs of issue will come in order to be the trigger that leads you to stop your NASDAQ trade, right? I mean, I think that's the order of operations. Something will happen elsewhere first that would lead to US equities finally getting sold.
Or this, absolutely rampage of fiscal deficit, uncontrolled fiscal deficit spending would potentially stop. And that would actually be drama because this is what's causing, Yellen to keep coming and financing this growing fiscal deficit with these T-bills, and it just continue, rolling. But the interest is also building. Anyway, long story short, we still have a backdrop of fiscal dominance, which is kind of politicizing their role, Fed and Treasury, to support, in other words, for lack of better words, kind of what's happening on the fiscal side. So this is really, they're driving the bus. Warren can come out as much as she wants and say, Fed, lower rates, but really it's Warren, stop spending so much so we don't have to keep, issuing all this supply. Anyway, we've got so far folks that are buying this supply, and right now we're in a little bit of a bond bid, stocks are bid backdrop. A question is being asked about small caps, and I know you have very strong theme about this. It's a wonderful whack-a-mole trade. When it pops up, you're basically short the rip because it's got 42% of their constituents are zombies, right? They're unprofitable. It does not have the AI tech moat of NASDAQ, doesn't have any of the Magnificent Seven that have such heavy weighting in XLK or, semiconductors or what have you. So there's really no reason for it to move higher unless we were to get a broadening out rally. And so far, we just haven't. We just haven't. We've gone sideways in Russell. Diamonds, they're trying to make it the mini NASDAQ by adding Amazon in there, but it's still suffering sideways. And then basically it really is NASDAQ, SPX, small caps, diamonds. So what's your view of small caps this year as it relates to the economy? Yeah. What would be a reason for it to move higher? I know your reasons for it to move lower.
Yeah. Look, I mean, we have a very bifurcated economy. Described it as a K-shaped economy where the haves keep winning and the have-nots keep losing, right? And the
In a
haves
nutshell.
are rich people, homeowners, and cash-rich corporates with low locked-in borrowing costs. And that's the same for individuals, right? Who can benefit from higher rate environments because they have excess savings. They can deploy that cash into asset prices and assets, and are doing incredibly well. They have, if it's individuals, they have jobs where wages are continue to be firm, growing at mid-single digits, and if they're companies, their profits are, generally fine, and they have interest income. They're buying back stock, and things are great for for that segment of the economy. And on the flip side, you have the bottom half of individuals who either don't own a home, have no assets, or are in credit card debt, that are really struggling from this higher rate environment. And then you have companies, small caps, and also private companies, you can't really trade, but that's where you would see this, is that these companies are strained, cannot get access to cheap capital, are being forced into paying higher rates of interest, and can't really keep pace with the inflation that's being generated by the rest of these companies and people that are spending. And so that dynamic is going to continue. And look, the Fed, this is what the Fed has done is, by neutering the QT and deciding not to kind of be more active with the balance sheet, the only tool that they're willing to use is the rate tool. And they have to think about the dynamics of inflation if they were to cut rates, or if they were to, have to raise rates further. And so I thought it was interesting. Powell made a comment today about, he said, when we start to cut rates, we know that it is going to lead to a pretty significant loosening of financial conditions. And I think that's interesting because financial conditions are already incredibly loose.
Yeah.
So what he's saying, I think what he's acknowledging finally, maybe, is kind of a subtle point, but it's like, hey guys, financial conditions are really pretty loose already. Like, we know that. We think monetary policy is restrictive, but we know kind of for parts of the economy, financial conditions are already very loose. So like, we can't really cut rates when financial conditions are already loose, because then they're going to make them even looser. Like, I think they kind of know that if and when they start to cut, housing prices are going to rip, right? He even said, housing, we have structural shortages in housing. Like, we kind of know that when we bring down mortgage rates, housing prices are going to go back up. So they're kind of screwed. They're like in a box. The other thing we know is that there is no appetite in DC to lower the deficits. Certainly not between now and the election, and probably even beyond that, right? There is no ability to raise taxes, and there's really no ability to cut spending. So the deficits are going to continue. So we just had this bizarre economy where the government has, where higher interest rates are kind of restrictive on the government, because it's being forced to pay out an increasing percentage of its deficits as interest expense. But because the Fed never lets the bond vigilantes kind of come out of hiding, there's no repercussions in DC. So we just have more and more deficits. I mean, the number just came out today, 357 billion of deficit for the month of May. I mean, it was 100 billion worse than expected. And we're up to 1.2 trillion. Next week, the CBO, this is actually a potential catalyst. Next week, the CBO will give an update on its expected deficit for 2024 and for the next 10 years. And they have already said that those deficit numbers are going up for this year, not surprisingly, given where we are year to date. But that could potentially be, another type of frying pan type moment where bond markets are like, wait a minute, like, we thought like deficits were going to come in at 1.6. Now you're saying it's 1.8 or 1.9. Like, I don't know what that number is going to be, but maybe that's something that wakes people up next week on the bond market, and they're like, wait a minute, this is way worse than we thought. And the other thing too, on debt and on our U.S. Treasuries is, what are BRICS countries going to be doing with US Treasuries. Is there a increased momentum into this kind of new financial order, this new monetary order where gold is being reintroduced? And, there's been a lot of talk about, this over the course of the last few weeks, certainly in Twitter, about pricing of oil away from dollars and the like. I think it's just I don't expect anything, heroic or any headline that says anything. It's just there's this constant drip of foreigners foreigners selling, foreigners taking less U.S. Treasuries, and what kind of impact that may have. Tomorrow we have a 30-year auction. We'll see how.
But they're buying our equities.
They sure are buying our equities. That is for sure.
That's an understatement. Okay, let me go through a few questions here because they come in late. Okay. Marty's asking, he actually asked earlier, but any thoughts on Freddie Mac, second mortgages, expanding SSI for welfare recipients? I would just say liquidity, more liquidity, or debt. And, the degree of debt doesn't necessarily seem to matter to the government. They don't see debt as repayable, I think, but individuals sure do. Anyway, any thoughts on that kind of?
I mean, look, this would be
political promises.
Look, I mean, it's an election year. God, it's so irresponsible. Basically, what you're doing is you're giving homeowners who are already largely benefiting from that they have low locked-in mortgage, an ability to go and access the equity in their home to go and spend more money. In the economy and in consuming. So I don't.
And they will.
And clearly that will be inflationary. Clearly that'll be inflationary.
Yes.
So it will increase the likelihood of a second wave of inflation that commences later this year and moves into next year. So.
But it will have a lag. So at first they'll spend and then the inflation will follow. So this is what kind of plays into a question about yields right now in my yield call. I still see yields falling into the summer, through the summer, and then picking up at the end of the year and into the beginning of the year. And curiously, it kind of times with, how Waller's been saying he doesn't see a rate cut until later this year, early next year. Powell is basically saying the same thing. I'm saying the same thing about yields. Like, I just don't see it until end of year, beginning of next year. So right now we're in this trough, and I actually see the potential not only of going to 4.2 in the 10-year, but taking it out. So I've written about that a lot, and that's also supportive right now in the short term for equities. But I think the market will start to kind of like, wait a minute, we just dropped below 4.2. Is that bullish or bearish? What's the narrative? So they'll start to check that. But, and we talked about the small caps, question on, okay. So the question on the 20 to 30-year yield, rising or continuing lower short term. My bet, since April 30th, is that we would have a bond bid, and it's not going to be smooth because it just isn't, but it is going to move higher, as yields soften, as this disinflation impulse kicks in. And the MOVE index, which is the volatility of Treasury, is basically, it peaked at 150, it broke 100, and I think it's going to head down. So as it falls, the 30-year will fall. Now, end of year, all of that reverses. So it is only a summer call for me, June, July, August. And I actually saw it late March and then said, I think it's happening, starting April 30th. And it's not been a direct line in any way, shape, or form. But to me, it is basing and moving, and bonds are basing for a summer rally, and yields are falling short term in this 20 and 30-year complex. That's my baseline bid. And then at the end of the year, nope. Inflation will start to rear its ugly head. On what reason, I can't tell you. Political commodities, other term premia, I don't know. But right now, I see what I see. Technically, it's been pretty strong. All right, so that's my bet on the summer. And as far as market tag, we already hit it. SPY 53.40 and the Qs at 472, and we could chop around there and grind around there. But ultimately, our NASDAQ bubble has only appreciated 78% since the January low. And in 1999 to 2000, we literally had a 100% move. between, from peak to trough. So we're not even there yet, which is, I know, it's hard to believe, but that's where I'm at. And yes, once this is done, we'll post it to our LaDuc channel, LaDuc Trading YouTube channel, also on our website. We have a new website. Yay, took a long time. You can see more about the team there, more details on Craig. We do these public webinars on kind of, important days where we're trying to feel our way through the dark and what's next. But we do this every day for clients. So we have a client Slack workspace with 10 contributors. Craig works directly one-on-one with Edge clients, phone, email, direct message. I run a live trading room. I actually ran 2 today. The second one was boring because we didn't really have any movement once we gapped up on CPI. The Fed release of their minutes and Powell's presser was pretty darn boring, relatively speaking. And then we've got, Avgo after hours, even propelling NASDAQ even higher. So fun times. But I think we answered lots of the questions, and I want to make sure I saw everything. Anything else that I might have missed? Oh, Druckenmiller, IWM calls got a lot of press. Jerome Burns. Okay, I would have trimmed already. Maybe he sees this fiscal dominance as very bullish too, right? And the dollar and yields are falling, which is very supportive for equities in general. And maybe he's got his reasons for believing that the small cap rally will broaden out. I actually was there early, like February, March, and I was really excited about the broadening out. Then it petered out, and I was like, and then gold spiked higher in March 1st, right? And that was it. The NASDAQ rally was off. Had to call off the melt up. Now guess what's happened? Gold, silver, precious metals, and industrial metals have come back down, and that has led to that rotation higher once again in NASDAQ and SPY. So the only reason I'm going to get really bullish, Russell, for example, is if we can get better breadth. And right now, breadth is still very, very weak underneath the surface for the Russell components. So I don't have a crystal ball on that. I just have some levels we need to get and stay above for small caps to really ramp higher.
Can I share my screen real quick?
Please. Yeah. Oh, I thought you had that. All yours.
This is a chart of Qs versus IWMs. Can you see that?
Crazy elevated. Yeah.
So this is just a 20, this is a 25-year chart, right? So this is the basically, 2000 high, obviously massive correction. But if you look at this like cup and handle here, I mean, just this multi-decade cup check back. And once we get through this handle, I mean, I don't know. This still looks great. And everybody came into the year and said, well, this is going to be the year for rotation. This is it on a shorter term basis, right? I mean, it's really just kind of done, this is the, Qs are right up, and this is done basically, it's been flatlined for 6 or so months. And then boom, it's just starting to go now. I mean, like this can move another, 10, 15, 20%, right? The next little bit
so extended. And we do have these periods where it gets extremely extended and then it reverts to the mean, right? And then builds up enough energy to move higher later. So it should not be a straight line. Parabolas are very bad.
So this is the one I think is the most interesting one, which was back during COVID, right? You had this breakout kind of into COVID. And then in COVID, the first move in COVID, as the markets were getting destroyed, this really went vertical. It's like as markets get hit, Qs outperform IWMs in a down tape at a beta move to the downside. So I think that's ultimately what will happen is that when they sell tech, they're going to wind up selling everything. And then this only really got alleviated, that was obviously Fed liquidity here. And then really it was the vaccines that kind of led to that move, right? Because we finally got cyclical growth momentum. I don't see a similar cyclical growth momentum trigger, at this point until we get the sell-off, right? Until we get a correction, until we get the need for liquidity. So I don't know. It just feels like that's not really coming. But so I have no I don't really think there's really going to be this broadening out rally. I think this is, going to be, NASDAQ is going to go and go and go until it breaks. And I don't know what's going to cause it to break. I don't know if it's going to be a DOJ investigation against somebody. I don't know if it's going to be an insider trading investigation against NVIDIA and this core weave. I don't know if it's going to be, one of these guys someone selling equity, or if it's going to be a stupid acquisition at the top, or I don't know what it's going to be, but it will be something. But I don't know if it's going to happen tomorrow, or if it's going to happen in 3 months or in 6 months, but whatever, it will happen at some point. But I don't think that the rotation is going to be from NASDAQ into crap. I think it is going to be from NASDAQ into cash as they wind up selling equities.
So on this comment, I really like this, because this hedge fund factor rotation, I know we're running just a few minutes over because I like to keep it on that power hour, but we started late. The hedge fund factor rotation, that is a thing that literally started up a little bit, got petered out, before the GameStop hoopla, but it is where they sell the VIP stocks that they have, right? The Mag 7, and they cover the shorts that have been very, very, very productive on the short side, the GameStops and the rest. Now, GameStop's in an old new category now, right? They did this big equity raise at the highs, and that, results in them having cash about $10 to $12 a share. So guess what? That's the floor. And even Citron came out today and said, yeah, we're out. Our short's not going to work. Why? Because they just put a floor. They're not a bankruptcy risk anymore. So this is going to be harder to do, that factor rotation thing for a sizable move. So I agree with you. It's more like they would go into cash versus into junk. But I like Jerome's comment too on soft economy fears. Maybe they continue to hide into mega cap tech. In other words, no rotation. He's agreeing with you. I still track that every single day, several times during the day, because I look for opportunity for this rotation to pick up, because it's a great time to buy Q puts, if nothing else. But I know we right now are in an AI tech bubble still, and we'll look for signs for macro interruption of the bullish complacency and the bullish option flow and the bullish money flow from abroad into tech. That's all we can do right now. But I hope we answered lots of questions, and that is correct. My daughter did not do this website. That was it was hard to say bye-bye to the Pelican, though. I will tell you. All right, cheers, everyone. Thank you, Craig, so much. All your detailed analysis, and we'll do this again in a few weeks when we have another kind of macro event for you to interpret.
Sounds good. All right, take care.
All right. Cheers. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.